I think it's going to be a very interesting one and a very different one because we're talking about investment process or processes, and what two very different styles. Investor here with me. I've got Erik Wetterling, the founder of the Hedgeless Horseman, and of course our host John Feneck. Easy question first off. Who are you and what you do?
Well, Erik Wetterling from Sweden. I am a full-time investor, been in the junior mining sector since 2015. I mean, after that Q1 rally in 2016, you kind of got hooked. It's like what they say, it's dangerous when you're lucky early on, because, I mean, that was a lot of luck. And since then I've done this full time, and it took, many years to actually get better and better. I know. Still learning, and I also, run kind of a newsletter. Like I post a lot of stuff on Twitter. I enjoy the investing process overall, since I have a background in poker, which I think was very beneficial. So I use that, probability thinking, let's say, and dispassionate investing, because in poker and investing, so you cannot afford really to be emotional about stuff.
Thank you, Erik. John?
Yeah, so I started in the business in 1992 as a analyst for Merrill Lynch. Moved on to JP Morgan from there, was an executive there for a few years, went back to Merrill, ran a bunch of branches for Merrill on the East Coast, co-ran them, and also moved on to another firm. After that, I actually retired in my 30s, which most people don't know. And then I took care of my dad, who had cancer, for a year before he passed away. So I really value that time, and came back in the industry and worked for Sprott on their PM team in 2016 and 2017. And then spoke at Beaver Creek in 2019, and had 3 CEOs come up to me and say, "Hey, you should be a consultant for the mining space." I said, "Oh, okay." And I changed my job. And so here I am.
Okay, Beaver Creek is the Precious Metals Summit, which happens in early September every year. Okay, let's bring in some Greek philosophy. Let's start with Socrates. Know thyself. What kind of investor are you, Erik?
That's a good question. I think it's hard to describe. I mean, I would like to see myself as a value-driven investor, like bottom up. I know there's, a million things that's totally unknowable, like for myself at least, like macro and stuff like that. So I just focus on stock picking through and through. I don't try to time the market at all. I ride the ups and I ride the downs, and as we know, there's been more downs than up, so you gotta have some staying power and thick skin. That's basically it. And also, again, just bringing, it's a numbers game for me, and that's how I like to see it in view situations.
Okay, and John?
Yeah, as a former analyst, I had 2 analysts that work for me to do the research now, because I don't have the time to read the 100-page, filings. But what I've transitioned into is building my proverbial Rolodex of CEOs, so that I can just call people like the people in the room and say, "Hey, can you give me an update for 2 minutes about your press release? Because I think this seems meaningful, but I want to put some, comments out there to my clients and make sure that I have it correct." Right. So we value the relationships we have with CEOs. We find them extremely valuable to be able to relay that information to clients. So I would describe myself as a value investor always, but I'm more of a GARP investor, growth at a reasonable price, where I'm not just looking at deep value. I will buy stuff like AbraSober, we just had the solar panel that's running because it keeps running for a reason. Conditions have changed in Argentina, so you have to get on board with that as an investor.
Okay, you've both got very different investment approaches, I think, and we'll hopefully get into that. You've both got very good contacts with the C-suite in the sector, so the information gathering is there, and in some ways I'd say it's similar. But in terms of your investment approaches, John, I imagine you've got more of a rules-based approach. Erik, I imagine you're perhaps more instinctive. John, talk us through some of your rules, your lines in the sand, do's and don'ts.
Sure. So from 1992 through 2019, I worked in the mutual fund and ETF business. And in the mutual fund business in the US, at least, it's very rigid. If you read the prospectus language of 95% of mutual funds. We have to be 80% invested at all times. We can't take more than a 5% position in any stock. There's a host of rules that you have to follow as a PM in the US. And I think that prohibits outperformance because a lot of when you actually call a PM in the US and say, hey, tell me how you're compensated. If they're honest with you, they're going to tell you that we're compensated on performance in the short term against our benchmark, right? It's not just the 5 and 10 year number. It's the 1 and 3 year number. If you're a large cap core manager, you're benching against the S&P, right? So how much outperformance are you giving us over the S&P? Well, a lot of times if your bonus just to beat the S&P, you might be only 100 basis points above the S&P. That's not exciting, for most investors. And so while I understand the dynamics of that, I think that having an unconstrained approach really helps us.
Yeah, so that other approach is perhaps more protecting against downside risk rather than upside opportunity.
Right. And we can carry large cash balances too. I mean, my energy portfolio right now is 40% cash because the oil trade has not worked out, right? So I can be 40% cash and not get shelled by investors, which would be shelling me if I was a public, mutual fund, right?
Okay. And Erik, given you've got perhaps more of an instinctive approach, are there any sort of rules, do's and don'ts that you live by?
No, I don't really have any fixed rules. I think it's, I like to look investing as an art, not a science. And of course, this is my approach. There's many ways to skin the cat. There's a lot of successful investors who have a completely different approach, but they at least have a strategy, let's say. So no rules based. I again, personally I think it kind of handicaps you. The only time I would think rules actually are worth it is that if it simply, keeps you from making an even bigger mistake, let's say. Until I really feel like I need rules to keep myself from, doing some mistakes, then I won't have any rules. And I do a lot of, soul searching. It's like, on paper, in theory, there's a lot of strategies that make sense. Everybody has heard, buy low, sell high. How many actually do it in practice? Almost nobody. So it's like, I like to play through some cases in my head to see, it's like, am I actually going to, the case I see, can I actually do that in practice, or am I going to sell it at some point? And then it's like the case looked good on paper, but in practice, I couldn't follow through.
Okay, now this is essentially why I began the session with the quote from Socrates, because it depends on how you are, how your personality is, to which investment strategy is most suitable for you. Okay, let's. You've got very different approaches to building portfolios. So let's talk a bit about portfolios, how you form a portfolio, what positions you take, the size of those positions. Sure. Let's start with you on this.
Well, yeah. So I run many different portfolios. I have, a specific risk tolerance for myself, and when you can get into, let's say, private placements and get warrants and all that, that's obviously going to change the portfolio composition, because my portfolio has a certain risk reward and a lot of, let's say, asymmetrical bets, and those asymmetrical bets get more asymmetrical if I have warrants. But if somebody can't copy that exactly, then it's not. They can't have really the same portfolio. They can own the same shares, but they can't actually or have the same portfolio setup, let's say. But then for like family members and friends, I do a very long-term approach typically, because like I can't trade 12 portfolios every day. So that's mostly cases where I think if I come back in 3 years, either something has gone really right, or I'm down to up to 100% per case. And the focus is like pipeline growth, let's say, that a lot of stuff can go right, but it's obviously going to take maybe years for that to play out. I think that, downside risk is low and not like volatility, but like actual downside risk that they're going to wake up and they have zero value or anything like that. So, and then of course, people gets very important, because the only way to play the alpha of a good management team is to give them time, right? It's like if you played basketball, if you put Michael Jordan in for 1 second, he's not going to affect the game really. But the longer you have him in there, the higher the win rate go. So yeah, so there I have not rules, but like prefer a bird in the hand. They have something that's really cheap, and then you get that free optionality. And then I sprinkle in some more higher risk cases, but they tend to be, you know, much lower weighting. Whereas like if the story doesn't work out, it's not going to kill the portfolio. But if there's enough upside, even a small position can have some meaningful impact on a positive side.
Okay, and John, how do you build your portfolio, determine position size?
Sure. So Erik brings up a good point that I just wanted to touch on first. If you go to our website, phennecconsulting.com, and then /performance, you can see our track record there for 9.5 years. And in that track record, we put nothing with regards to warrants, private placements, anything that I would have an advantage, as someone who gets calls from mining companies every day. That's not in my performance. This is my retail performance that's on my website. So I just want to make that clear. How we construct portfolios is using a hub and spoke structure. So we buy GDX and GDXJ as the two big ETFs in the space, right? In the gold side. And we buy things like SILJ, SIL, SLVP on the silver side. And so we have, probably 15 to 20% usually in those kind of ETFs as the core, right? And then you have spokes. So spokes would be things like, we just talked about on silver, Aftermath Silver, AAGFF, AberSilver, ABBRF. We have all these stocks that are on the periphery in 1 or 2% positions because they can add tremendous output to the portfolio, right? But we still have to be mindful that some of those companies aren't producing yet, right? So like in a hot market like this, you want to have ETFs where they hold the producers, the names I just mentioned, and then also sprinkle in some other producers, but a lot of exploration and development plays as well.
Are you guys sort of one in, one out investors? You maintain your portfolio. If you like something new, you've got to sell something to replace that.
I don't really see myself that way. I know what you're saying, but I feel that things just happen sometimes, right? Like I look at RSI a lot, relative strength index.
Let me jump to my next question. What metrics do you use to evaluate investment opportunities? How do you determine if it's good, not good? And John?
RSI, relative strength index, is something that I really take a look at every single day. So when I fact check myself, right? A good example would be Core that just was as I mentioned recently, the 550 a share. It's now at 766 close last night, and the RSI was 75.1. So whenever RSI gets above 70 to me, I start getting nervous because I know that a lot of intelligent traders are looking at this. And in a hot market like this for gold, I'll let it run to 80, but rarely will I not be selling something at 80 RSI because I can tell that there's going to be some selling at some point and then it can feed on itself.
So for you, it's a mechanism, a way of timing your investments. You might see something you really like, but is it the right moment to buy? Is it the right moment to sell?
Well, something like CDE is a great example. I've owned that stock since inception in 2016, but I haven't just held it. I've traded it a number of times because I don't have a relationship with that stock or that company like I do with other companies, right? And I think, like, let's be honest. People matter, and you invest with people because you trust them. And so that's the emotional side, I guess, of investing, and the other side, the fundamental side, right? It's not just technicals and looking at charts. It's, hey, this person has never done me wrong. They had a takeout over here. Now they're doing the same thing with a new junior. I have that relationship. There's a series of things, but RSI is something I look at every single day.
And Erik?
Well, I don't really have that. I don't look at anything in particular at any day. And it's like how I look for opportunities. Usually, again, people plays a big part. And there's also, very different type of opportunities. If you have a, simple one target project, let's say, and you figure that's like, well, anybody can pretty much, let's say, test that target. You need, how good does the management team need to be, let's say, if you believe in the target. But as always, like typically, good people tend to come with good projects. So, and I've done some examples. Let's say I put together I call an example portfolio. It's like third-party validation. I just picked 20 juniors who all had like majors or mid-tiers at least, with some recent, vote of confidence that they were in them. Because then it's like, I'm not a geologist or a mining engineer. So if a major mining company says we see potential here, it's like that's worth a lot. And then I can look at what the market cap is and figures like, is this pricing in something that B2 Gold or Newmont would like to have or something. And most of the time it doesn't. But again, it's like not that everyone will work out, but at least you know then that there is geological potential, because you have some of the best geologists in the world saying as much. And yeah, so I was, to wrap up, I look at a bunch of different things, but I always want to come out with it's like when I have a call with a management team, I'm start to think in my head, it's like, how does the risk reward play a part here? And then I usually, basically tell them the case I see, and they can correct me if, I'm wrong. So it's like I usually get a gut feeling about the risk reward, and then I dig in, and then I usually take a starting position, let's say, because some people say you don't know a company until you own it. So start with that, and then just, dig and dig and dig, and then sometimes I end up with a high conviction pick.
Okay. Let's talk about value or valuations. What is cheap, what is not? The gold price is high and rising, but it's not impacting all stocks equally. So, Erik, we were talking about this yesterday, about cheap. What is cheap for you? How do you determine what is cheap? How do you determine what is expensive?
Right. I mean, since I'm always fully invested, I think the whole sector is cheap to begin with. And at the same time, as I became, my job is, I don't have a problem finding something that's cheap. It's like, I want obviously the cheapest. So it comes down to like intersector relative valuations. I never really used to care that much about the second Lassonde curve, for example, developers and stuff. That was too boring for me, really. And you kind of needed to have the, exploration success to get the 5 to 10 bagger potential. But it's like, for the first time since I've been in this sector, let's say the peak of the second Lassonde curve, like in production, the margins on the gold miners especially, it's like it's never been higher. So the second Lassonde curve has probably not been worth more than, in over 30 years. And you look at especially the gold juniors, they're not even remotely pricing that in. And of course, sometimes it's actually correct, because they don't have a project that ever gonna get into production. Then it really doesn't matter if gold is at $50,000 or $5,000. So, right now, and this changes depending on, how the market moves in the sector. Right now, my personal favorites are the ones who have a project already that could actually get into production, and not preferably in 10 years. And also where you then get this free optionality on the exploration. With that said, I own quite a bit of explorers, even some pre-discovery explorers, because they're also cheap. It's just that from a risk-reward perspective, I don't think you can beat the ones who have already their bird in the hand is the most valuable it's ever been, given the gold price, and assuming they can actually monetize that. And if you get exploration potential for free, it's like, people who know me, there's no secret that First Nordic is a very large holding of mine, because I think they have, basically ticks those boxes where you buy something that, a great project, a great deposit for much less than I think it's worth, especially if it would be in production today, and you also get some of the best exploration potential. And if you're not paying for that, that's de facto, in a sense, risk-free upside.
Okay. John, you talked about RSA. Is that the main sort of metric you use to judge cheap, expensive, or is there something else you look at as well?
It's extremely reliable on the sell side for me. So anything over 75 gets me worried. And I will be trimming and maybe selling the entire position, but I never sell all at once, especially if it's a junior, because I might move the market, because I then tell my followers and clients, like, hey, I just sold this and I don't want to mass exit us out of anything. But in terms of anything else, I use support and resistance every single day. Support and resistance levels on charts, 3, 5, 10-year charts, is extremely important to me. because charts is where I start. I start technical, and I also look at the fundamental side. I do both. But charts, when a chart breaks to the downside, you have to be careful. I mean, like you have to decide at that point, do I sell this or do I hold this? Because now major support is broken, and you should be selling. And so that's when you make a phone call to the CEO and say, hey, tell me why I shouldn't be selling, right? I'm going to give someone a chance to tell me. But if there's no catalyst for the next 1 to 3 months, I'm probably going to have to move on, because the stock's going to be, there's a real problem in our sector with mass selling. Last year we had a lot of Canadian funds go out of business, right? Like they're going to sell juniors because they have to, they're going out, right? Like it's not because they want to. And so when you have selling pressure, that can get exacerbated in times like November and December, which is traditional tax loss season, right? We saw that play out again last fall.
Well, this moves into my next question quite nicely. I want to talk to you both about anchoring and how you deal with that, because human psychology, you tend to anchor on something. In investing, you tend to anchor on your entry point, the price you've paid, and everything else that happens after that, you tend to evaluate relative to your entry point, your anchor point. And obviously, particularly if you're holding for something for a long time, conditions can completely change. The world economy can completely change. Your anchor point could be no longer relevant and off by quite a factor. How do you deal with that? You often see, one of the sayings or in the sector is, when you get a double, take half off the table. But that if a stock's going to continue going up or can continue going up, you're going to miss a big opportunity. A very good example of that could be philo mining. From $2, it went to $4, it went to $8, and it continued going. If you'd have taken half your money off the table when it doubled, you'd have missed a lot of upside. Enough with him for me. John, how do you handle that issue of anchoring and getting over that, getting past that?
And guide me if I'm not answering the question directly, because I want to do that. I feel like we're all human, and when I'm using my metrics, like I did this with Avino recently, my average cost was 53 cents on ASM, and we just sold the entire position around $2 to 202. Why? Because the RSI got to like 80, and I was like, I've made money. I feel like I have a responsibility to my clients to make them money. I wake up every day and I have to grind. That's how I feel. And that's why our performance is what it is, because most people don't care. They really don't in the PM world. They just phone it in. And I've worked with PMs and in the mutual fund business for 25 years. So I have a reason behind that statement, right? I feel like a lot of people don't feel they're fortunate to be in the position they are, and I do. So I feel like every day I'm going to give it my all. And I'm not always right. Days like yesterday are very humbling, but it's okay, because today's a new day, and I look at every day as a new opportunity. In terms of anchoring, I mean, I'm constantly adjusting. You had just mentioned about like a story changing, right? Let's talk about that. Alexco was a high flyer. Every one of my peers and newsletter writers loved that story, and I never bought that story, because I called the company and I said, tell me about this water issue you have. Tell me about why you didn't raise more money, right? And these are things that killed the stock. They ended up selling for pennies on the dollar to Hecla. Look at Hecla's release last week, HL. They talked about this project as a problem. If you read through it correctly, and it wasn't on the analyst call, but to me, it seemed like this was a problem. And so I put out a note to my investors down about, 8%, saying this thing's going to get killed today. And it was down almost 20% that day, because it just fed on itself. Selling will feed on itself when people start to realize, oh, this is going to be a problem potentially. And it's a shame, because it is a good project, but decisions that you make as a mining executive are important. We both agree on that. And so sometimes you have to pull a plug and just move on.
Okay. Erik?
Yeah, I don't have much problem, I think, of selling losers, let's say. Because, hey, I mean, it's not too fun if you look at our positions down 80%, let's say. Might as well get that out of there, so you don't look as stupid when you look at your portfolio. I mean, I like to save people, and because I hear all the time, people complaining, let's say, about their junior portfolio, and in my opinion, it's like, well, this is probably the best buying environment I've ever seen. I thought 2015 was good. and 2020 flash crash was good. But I mean, this is even better because like the blue sky for gold is, for example, already happened. So it's already here. And they refuse to buy low right now, for example. And they're like, oh, as soon as I get back to even, I'm gonna sell. Or they don't want to sell whatever position they have, that they don't know why they bought it, obviously, because they're not buying more. They're trying to keep themselves from selling it. So your portfolio is obviously not going to thank you from, okay, you're minus 70% in a case, and maybe it's a busted case, maybe it's a failed case, and there's like all over the place, there's actually cheap, intact cases, but from your stubbornness, you think you have to make it back in the same stock. It's like that, every single mistake like that, it's like they all add up. So you see a lot of people like, you know, they still can't really figure out what went wrong. When in reality, they obviously bought high, refused to sell low, refused to change their, let's say, approach, and they get lazy. It's like they're waiting for the market to bail them out. Whereas like, as John said, it's like he's grinding every day.
Yeah, move into something else.
But there's a lot of like a lot of people that just I think they have. I mean, the people with usually the worst past performance, they have the highest expectations of the future. They're chasing, you know, the more they're down, they want to take even more risk, and they again refuse to like take a loss in a position. So I don't know if that it's an ego thing or something. So I just try to keep my mind on the price, which is long-term portfolio performance. So you're going to have a lot of cases throughout the year. So it's like, just stick to the only thing that really matters.
That's much more of a gambling mindset, isn't it? It will eventually come good if I hold them and stay in long enough. Okay, let's take a little bit of a sidestep here and talk about the broad market. I think it's very relevant to talk about this because the stock market volatility with some of the actions in response to some of the actions and sayings of President Trump has been quite traumatic for a lot of people. So many people believe that the general stock market is perhaps heading for a big reset or even a crash, which is one of the reasons why natural resources are starting to get some investor love. How can or should people move out of investments in the general stock market into the natural resource sector? What are the ways and means that perhaps should be used, John?
So I have a lot of strong thoughts about the broad market and the rally that we've seen from 2009 to right now. It's been over 16 years. And I tell this to people all the time because I'm a firm believer that people don't have their serious money in our sector yet, right? Like they have their play money. They have most of their money in their 401k and the S&P, the NASDAQ, these things that are very susceptible to a pullback here. And by pullback, I don't give numbers. Like I'm not one of these guys that says the market's going to crash 50%. I don't believe that. But I do believe that a traditional, recessionary correction is 20% plus. And I think we could see that very easily based on promises that aren't delivered, right? Like yesterday's market action was a perfect proxy for this conversation. You saw the NASDAQ, the S&P crank on the US-China tariff deal, right? What did GDX and GDXJ do? Like the worst day I can remember all year. That's really a positive for us in the room and for anyone watching this because GDX and J now are being seen differently than the actual equity market, which is what I've been talking about since last fall. When we see decoupling in the miners, that's actually a positive sign because when the market corrects, the miners are going to start moving up. And when we get that sector rotation, that's when it really gets fun for our sector.
Okay, I've been given the signal that we've run out of time, so please join me in thanking Erik and John.
Yeah, thank you.